Hey there, history buffs! Ever wondered how a simple piece of paper came to be worth its weight in gold, shaping the entire global economy for over a century? The gold standard dominated the 19th and early 20th centuries. It linked currency value directly to gold. This created a fixed exchange rate system. Currencies could be converted into gold. This system facilitated international trade. The Industrial Revolution created a need for stability. The gold standard emerged as a solution. Major economies adopted this system. This era witnessed unprecedented economic growth. However, the system's rigidity led to its downfall. World War I marked a turning point, forcing countries to abandon the gold standard. The mechanics of the gold standard were straightforward. Each country defined its currency by a fixed weight of gold. The US dollar was pegged at $20.67 per ounce. This allowed paper dollars to be exchanged for gold. Convertibility was the system's cornerstone. It kept exchange rates stable. If currency supply exceeded gold reserves, its value dropped. This made exports cheaper and imports costlier, correcting imbalances. This was the price specie flow mechanism. It maintained balance in payments and exchange rates. The gold standard's stability boosted international trade confidence, but its rigidity posed challenges. Governments had limited monetary control. They couldn't print more money during recessions. This inflexibility could worsen economic downturns. Economic growth and interconnectedness. However, the gold standard's impact on trade was not without drawbacks. The system's emphasis on gold reserves as a backing for currency limited the ability of countries to expand their money supply. This restriction could hinder economic growth, particularly for developing countries that needed greater monetary flexibility. The gold standard offered several advantages. Its most significant benefit was price stability. The direct link between currency and gold acted as a natural brake on inflation. Governments could not simply print more money to finance their spending, preventing hyperinflationary scenarios. The gold standard also instilled trust and credibility in the monetary system. The backing of a tangible asset like gold provided confidence to both domestic and international investors. This trust fostered long-term economic stability and predictability. However, the gold standard also had its disadvantages. One major drawback was its rigidity. The system limited the ability of governments to respond effectively to economic downturns. During recessions, governments could not easily stimulate their economies through monetary policy, as they could not simply print more money. Another disadvantage was the potential for deflation. If the supply of gold grew slower than the economy, it could lead to deflationary pressures. This could result in falling prices, reduced business investment, and economic stagnation. The 20th century brought about significant challenges to the gold standard. World War I marked a turning point. The conflict disrupted international cooperation and forced many countries to abandon the gold standard to finance their war efforts. After the war, attempts to restore the gold standard proved difficult. The war had left major economies with large debts and weakened financial positions. Returning to a system that limited their ability to control their money supply seemed impractical. The Great Depression of the 1930s dealt a further blow to the gold standard. The economic crisis led to bank runs and a decline in international trade. Countries, desperate to protect their gold reserves, imposed trade restrictions and abandoned the gold standard. The system, already weakened, could not withstand the pressure of a global economic crisis. The experience of the interwar period highlighted the limitations of the gold standard in a world of increasing economic interdependence. The system's rigidity and its inability to adapt to external shocks proved to be major weaknesses. The Bretton Woods Agreement of 1944 marked a departure from the classical gold standard. It established fixed exchange rates pegged to the US dollar, convertible to gold at $35 per ounce. This system facilitated post-war economic recovery and international trade. Inflation from the Vietnam War led to the end of dollar convertibility to gold in 1971. The world shifted to floating exchange rates, introducing volatility in global trade and finance. The gold standard, despite its demise, continues to cast a long shadow on modern monetary policy debates. Its legacy lies in the lessons learned about the importance of monetary discipline and the dangers of unfettered money printing. The gold standard's emphasis on limited government intervention in monetary policy resonates with proponents of sound money policies. They argue that a system with a tangible backing like gold promotes price stability and responsible government spending. The appeal of a tangible backed currency persists, as evidenced by the enduring interest in gold as a safe haven asset. Investors often flock to gold during times of economic uncertainty, seeking its stability and inherent value. While a return to the classical gold standard is highly unlikely, its underlying principles continue to inform discussions on monetary policy. Central banks around the world strive to maintain price stability, recognizing the lessons learned from the inflationary experiences of the past. The gold standard, a monetary system that once underpinned the global economy, has left an indelible mark on history. Its legacy lies in the lessons learned about the importance of sound money, the challenges of maintaining fixed exchange rates, and the enduring allure of a tangible backed currency. While the gold standard may be a relic of the past, its influence can still be felt in modern monetary policy debates. The system's emphasis on monetary discipline and price stability continues to resonate with policymakers and investors alike. As the world navigates the complexities of the 21st century global economy, the gold standard serves as a reminder of the importance of a stable and predictable monetary system. While the specific mechanisms may differ, the fundamental goals of price stability, trust, and predictability remain as relevant as ever. Understanding the successes and failures of the gold standard can provide valuable insights for shaping a more stable and prosperous economic future. Thanks for joining me on this historical journey. If you enjoyed this trip back in time, don't forget to like, share, and subscribe for more fascinating history bites. Until next time, keep exploring.